we are getting our mortgage. We applied, talked through an advisor, and they helped us to apply, and we passed all the checks and everything. What are other reasons that our application can be denied or the deal can be cancelled?
Sure. So there are a variety of reasons why an application might fall down. So firstly, the first hurdle is credit scoring. So if you don't pass the credit score, the lender won't lend to you.
Yeah.
So that's the first one. But let's assume that you do pass the credit score. The next one could be that you are unable to evidence the information that you provided. So this is something that your advisor should be checking up front, but let's assume they haven't done that for now. If you told me that you earn $50,000 a year, but actually you earn less than that and your pay slips demonstrate less than that, then that could affect how much you're able to borrow. Similarly, if you have more debts than you've declared, or you've got some old debts that haven't been updated on your credit file, that could also affect how much you're able to borrow as well.
How about you have this income, but it's not stable? Like you have one stable income and on the side, you have this side hustle, let's say, and it's not exactly the same each month, but you declared it as your annual income from the last year, but this year is not, it might not be the same. It might be more, it might be less.
Sure.
Would that be a reason for mortgages to be failed?
So it depends really on what the lender's criteria is and what the side hustle is. Now, most side hustles are on a self-employed basis. So if you're self-employed, lenders generally want at least 2 years worth of figures before they'll take it into account, and they tend to average those 2 years figures as well. So that tends to provide them with some comfort. However, if your income is too erratic, or there's not a good enough story behind this, the lender might turn around and say no. And that kind of highlights a broader point as well, which is not giving the lender the full story. So you want to be as upfront and truthful as possible with your lender, or with your broker at least, when you're arranging a mortgage, because it's going to come out. And when it does come out, if it's not been revealed up front, the question that always lingers in the underwriter's mind, the underwriter is the person that's assessing your application at the lender, that is, well, I found this. What other things haven't I found in the background that this person isn't telling me about?
So it's basically all your financial information is under the microscope.
Your financial, but also your personal life. So what I mean by your personal life is what's happened in your history that could have an impact on your ability to repay this mortgage.
Like what, for example?
It can be things like if somebody's had, we've talked about adverse credit before, where somebody's got missed payments or defaults or CCJs. Now, a lender...
But isn't it more of a financial identity than the personal life?
Well, it can link to your personal life, because if a lender finds out about this and it hasn't been declared for whatever reason, or there's something on your bank statement. Another easy example is there's things on your bank statements that you haven't told the lender about, but actually indicate that there's more outgoings or there's more debts. One that lenders actually really hate is gambling. They don't like to see gambling on bank statements.
Okay.
That's one lenders don't like to see. Yeah. But generally, it's the situation where the lender thinks that you're not providing as full a story as possible about why something occurred, or they think that there's a likelihood or a danger that this could be happening. But actually, that's not even the most common reason why applications fail. So to understand how mortgage applications work, basically what the lender is looking to do is do two things. They're looking to approve you as a candidate, and then they're looking to approve the property and say, so A, is Naeem a good candidate for a mortgage? Can we lend to Naeem? If the answer is yes, great. What they're then looking at is, can we lend on the house that Naeem wants to buy? And if that answer is yes, you got 2 ticks, then you get a mortgage offer. However, if they turn around and say, well, we could lend to Naeem, he's a good candidate, we like him, but actually the house that he's looking to buy, we can't lend against for X, Y, and Z reason, then the application fails. And actually, so with any purchase, especially in England or Wales, what can happen at any point throughout the transaction period is that the chain can fall apart. So firstly, are you familiar with the property chain? Do you know what that is, or do you want to explain?
I'm actually not.
Cool. So we have a weird way of buying and selling houses in England and Wales. A lot of friends from abroad think it's very strange, but essentially what happens is if I'm selling my house. You decide that you want to buy my house. Great. But you own your house already, so you want to sell your house in order to be able to buy my house. So we sell it to a third party. Let's say we've got a friend called Andy. Andy buys your house from you, and Andy's got to sell his house. He's going to sell it to somebody else. That person happens to be a first-time buyer, so they don't need to sell anything. Now, we need all of those transactions to all take place pretty much simultaneously in order for all of our purchases to go through. If Andy pulls out for whatever reason, let's say Andy can't get a mortgage. Suddenly our chain falls apart because you can't sell your house in order to buy my house.
What's the point of doing something like that?
Completely irrational. But no, the short answer is that people in the UK like owning houses.
Yes.
And we don't like the idea of temporarily moving into rented accommodation in between buying houses. In other countries, that's not such a big deal. In the UK, we construct these chains, and these chains can go not dozens, but 10, 15, 20 transactions all simultaneously. And if one of those falls apart, the entire chain can fall apart.
When the chain falls apart, the deal doesn't go through, right? That's the only issue.
Correct.
And you need to wait until everybody, chain is completed.
Precisely. Because somewhere along the line, somebody can't afford to pay that person the money that they need to pay. And so until you can find a way to fill that hole, that gap in the chain, the chain's stuck, essentially.
Okay, that's very interesting.
And that's pretty much the most common reason why. So somewhere along the line, somebody can't get a mortgage, or the lender won't lend on a particular house, and that's what kills the chain.
Okay, you mentioned something about so mortgages can fail for two reasons. Mm-hmm. One, if your credit score or your financial checks didn't go through.
Sure.
And the second one, if the checks on the apartment or the property that you're trying to buy didn't go through. Sure. What are those reasons? What are the most common ones?
So there's lots of different reasons why that can kind of happen. It does depend on the property. With every flat in the country, every apartment in the country, the lender will always say it's down to valuer's comments. That's basically just a nice way of saying we're not going to say definitively that we'll lend on this property until somebody's actually been around to have a look at the property and made a call as to whether or not it's acceptable. There can be various reasons to construction of the property. If there's damp or any sort of structural issue with the property, that can affect a lender's ability to lend against the property. So they may turn around and say no. Essentially, what the lender is always going to be concerned about is one fundamental thing. It always comes down to one fundamental question. If this person can't pay their mortgage, we have to take possession of this property and we have to sell it. How easy is it going to be for us to sell?
I see.
And if you're buying a flat above a restaurant that's got lots of noise, lots of smells, lots of food, all that sort of stuff, that's difficult. Even if it's a really nice smelling bakery, not everyone wants to live above a bakery. It also explains why flats are harder to lend against than houses, because everyone's fine living in a house. Not everybody is okay living in a flat. So the market of people that you can sell to is reduced. Not completely, but it's a little bit more reduced. So that's why lenders will have stricter criteria for flats than they would for houses.
I see. In that sense, getting a mortgage is a good idea because basically lender is checking this type of stuff, right?
Correct.
So you're making sure that you're going to get the best possible deal.
Correct.
If there is something wrong with the property that you're trying to buy or someone just trying to scam you, then it will come up.
100%. Well, not always. Not always. I will say that because there are different types of different depths to which the lender can go in terms of the survey that they do on the property. So they can do a really basic survey just to make sure it's mortgage okay from a mortgage perspective.
Yeah.
Or they can go into more depth. That's called a home buyer's survey or a structural survey. And they go into more depth and they work more on your behalf than the lender's behalf. So even if you're buying a property for cash, getting a survey done is a sensible idea. Okay. It just reduces the number of surprises that are likely to come up. And when you're buying a new build property, getting a snagging report is also a very good idea.
My last question on this topic, which type of lenders are actually doing this extensive research? Is it like a banks or private lenders? Or
can you rephrase the question? I'm not quite sure I understand.
What type of lenders are actually going into details? Just they don't do soft checks on the property.
I see. So every lender. Every lender does a survey of a property.
Yes.
Now, how they do a survey of the property is dependent upon a few different factors. It depends on who the lender is.
Yeah.
It depends on the what's called loan to value. Loan to value is a really simple concept. It's what proportion of the property value am I borrowing? So if I have a 10% deposit, my loan to value is 90%. If I have a 15% deposit, my loan to value is 85%. Really straightforward. Now, every lender will want to do a survey of the property, but they'll only do a basic survey for mortgage purposes. They won't go more comprehensive than that. That's basically just making sure the property is standing upright and it's not going to be terrible to try and sell on or anything along those lines.
Yeah.
If you want more in-depth stuff, that's where you go for the more comprehensive survey. But sometimes if you've got a really large deposit, like if you've got a 40 or 50% deposit, some lenders will just do an online survey instead of going to do a physical inspection of a property.
Oh, I see.
Because they trust that the amount of deposit you're putting down is going to override any real issues around them being able to sell the property on and get their money back.
In that case, we can say if you want to get a proper decent check or decent survey on your apartment or the property that you're trying to buy, you need to go for you need to outsource that. Like you need to go for a private company to do that for you.
Yes. So I would say a couple of things there. So the first I would say is the lender's going to do that for you to a certain degree. And it depends on the type of property that you're buying and how familiar you are with that property and whether you think there's going to be any issues or anything along those lines. But secondly, if you are going to outsource that to a third party and get them to do a survey for you, wait until the lender has done their survey first, because you're going to have to pay for their survey regardless. And then if their survey shows something, it means you don't have to pay twice. But secondly, once they've done theirs, if you then go and do your survey, you've got access to more information about what you want to do with that survey. You can pay the lender to do a more comprehensive survey if you wanted to, or you can pay a third party to do it privately yourselves. Typically, I recommend doing it yourselves after you've had a mortgage offer from the lender.